Thank you very much for your great support. I want to say a big thank you to the founders, co-founders of Genesis Ventures. I think this is a great forum, and you have so much diversity. So we are going to start with panel one, and panel one is about engagement, actually, because we have a perfect panel for you. We have people who are actually in the space of venture capital, venture debt, and of course, bankers. And it's very important that we hear from them very quickly. So what I'm going to ask from all of you is there's a Pigeonhole link. Please post your questions early. I'm watching the clock. I only have 40 minutes, and this is such a big topic. I think essentially we are dividing this conversation into three parts. We're going to talk about the hyper-liquid market, and I think the data is obvious. You have been reading about the amazing numbers of IPOs, SPACs that have gone on to the markets. But we want to address this issue from a very macro perspective. And in a little while, I have two wonderful panelists on site here at the greenhouse with me. So a warm welcome to SMU Greenhouse. With me on the panel, we have Andrea from PwC, and we have Jeremy Lowe from Venture, from Genesis. But off-site, we have three sterling voices representing the investor market. So let's start with Andrea. Andrea, I really like your profile, and I'm happy that PwC is a partner to Genesis Ventures. So in your role as head of Southeast Asia, corporate finance and partner of PwC Singapore, I think we would love to have your thoughts immediately on what are some of the macro trends, and with so much liquidity in the market, where do you think a lot of our investors should be focusing their attention on?
So let's take a step back and ask, why is there so much liquidity in the capital markets? 20 to 30% of the US dollar money supply was printed in the last year. Let that sink in. Usually central banks are quite conservative and we're expecting slow, steady growth. But there have been unprecedented levels of stimulus in the economy due to the COVID response. So what happens? We haven't even seen the velocity of money come into the economy yet. For much of the last 6-9 months, we've effectively been in lockdown. Once the velocity of money kicks in, we're going to see inflation. Now, we haven't quite seen it in the CPI numbers yet, but inflation is coming. So what does that mean for us as an investor? Can you put your money in the bank? I think at the moment you get less than 1%. In countries such as Germany, if you have more than X dollars in the bank's actually going to deduct money from your account. Then you're thinking, do I put this into the equity markets? Oh gosh, are the equity markets a little bit overheated at the moment? What does that leave you with? What's exciting at the moment? People are looking for higher yields, higher returns. Venture capital investing. That's the exciting part at the moment, and that's why we're here today.
Okay. Thank you, Andrea. I actually like a quote that the team has prepared for me, that your greatest excitement is in closing a deal, looking for a deal. So can you kind of elaborate on that? What's so exciting about that?
My family says that I'm happiest when I'm doing deals and grumpy when I'm not. So whether it's closing an M&A deal or whether it's trying to raise capital for my clients, I'm very excited to be there in the trenches with them, helping them secure either capital or, for some of our investors, an exit mechanism.
Thank you very much. All right, great having Andrea with us. Now, I saw questions coming in, and I'm delighted, okay? That's what professors love to do. We love to have questions, so please keep them coming. I'm going to move to Kilok, actually, all right? Because Kilok, you would come in perfectly for this next flow that I'm looking at. And of course, everybody knows Mr. Chua Kilok. He's the president and CEO of Vertex Holdings. Tremendous background, many, many years of having looked at ventures, those wonderful, investments that Andrea gets so excited about. So Kilok, I'm actually going to ask you, you were quoted as saying that, there was a particular deal, Series A funding, you were the front runner, and then some crossover fund stepped in and took it from right under your nose. So with so much liquidity in the market right now, how do you pitch, all right, see, it goes the other way. How do you actually tell the companies that you are actually running after that you are the right partner for them? And is it true that there is so much liquidity? All right, will people be selecting Vertex, especially over other venture capital companies?
I think this code you're referring to actually is something that my US partner had mentioned in one other article. I think the US market especially is getting very hotly contested. So a lot of people are fighting over this deal. And I think the partners, our US partner was just reflecting on that even crossover fund typically only invest in the later stage deal, has also come to very early stage deal. They're just trying to show that crossover fund, which traditionally only pre-IPO, today they have a crossover even with the early stage deal, which is a very challenging in a sense. So I think your key question is how do you make sure that you get the right attention from entrepreneur? It boils down to the investment you have made, and also how you have helped the entrepreneur that you supported in the region. For Southeast Asia, we have less of this problem because we have supported a lot of very successful entrepreneurs. Usually when we are fighting for a deal, we will ask potential entrepreneur to have a conversation with Anthony, conversation with Joseph, and conversation with many other successful entrepreneurs, and then to get them to have a feel of how we work with them and how we contribute to them and value add to them. So I think beyond money, it's important to make sure that the entrepreneur feels that we can help them to grow the business over time.
Very nice. And I know for a fact, all right, that Vertex is actually very good beyond liquidity. So I'm going to switch gear a little bit because there's so much that we could tap on Keylog in a little while. I'm going to switch gear to the debt side of the business. And I guess I would like to engage my panelists from the virtual platform first, and I'll come to Jeremy in a little while. Yeah. So, today's market, low interest rates. So I actually would like to have Mr. Aozora Kito-san from the Aozora Bank. And this same question I would also like to direct to Pak Tigor so that we can hear from both of you at one go. So given the tremendous low interest rate environment, a big driver for the liquidity in the market, and a lot of investors, both short-term and long-term investors, are also seeking higher returns. How do banks then think about increasing your return on loans given the current low interest rate environment? Ito-san first.
Yes. Can you hear me? Okay. Thank you, Professor Panelist, and Ito from Aozora, based in Tokyo. In Japan, the interest rates have been low for about 10 years. The previous Prime Minister, Mr. Abe-san, started a new economic plans in 2012. Included the injection of a large amount of money into the money market. And 2016, started a negative interest rate policy. In a way, Japan has ahead of other countries in terms of experiencing the ultra low interest rate. And our Aozora banks, almost all Japanese banks have had to adapt to this environment. So our typical ways to improve return were to increase fee business like M&A, placement fee, and shift allocation with domestic debt market to specialty finance like LBO and US market debt, and increase exposure to other asset classes like private equity. And we have used a combination of the above. Thank you.
Thank you very much, Ito-san. So absolutely, diversification into other markets. What about you, Pak Tigor? I know rupiah interest rates is a lot higher, but I'm very sure that you're also looking at how to grow returns for a bank perspective.
Thank you, Annie. I hope everyone can hear me. Okay, great. So I think the way I see it, it's probably going to be a lot more boring answer, because the way I see it is more on the cost base, right? When there's a lot of volatility in terms of revenues, us banks, we have a heavy cost base that we need to concentrate on. Now, the cost base is not just the regular cost base in terms of premises, platforms, and so forth. That's one piece of the cost. But the second piece is on the cost of fund, right? And with us, with CIMB Niaga, we've been really focusing on this over the past few years to really increase the CASA, the current account, savings account percentage. So we're at about 63, 64% CASA based from the deposit, as opposed to it was about mid 40s about 4 or 5 years ago. So that's a second piece of the cost base. The third piece of the cost base of a bank is the provision cost base. And that's what we need to look at. How much provision that we have to put aside given the portfolio that we do have. So if we control those three buckets, the actual platform cost base, the actual cost of fund, the provision cost, you're probably 70, 80% there. Now, on the flip side, on the revenue side, on the loan side, given that we're trying to make sure that the cost base is actually very, very thin and very, very competitive, then you can have your pick in terms of who do you want to lend to. Otherwise, you're going to be lending to those guys that other banks don't want to. So if you have your first pick, most likely is going to be the much better credit. And thus, again, the provision expenses, the cost base of that line item is going to be much, much more competitive.
Very good answer, Tigor, which nicely allows me to segue into venture debt. All right, because, with venture debt, you're looking at a different set of cost-based funds, but at the same time, you also have a very different group of clients to lend to. So this question is just for you, Jeremy. So are you finding it hard to convince founders to take some venture debt from you, given the abundance of equity? They have the likes of Kilok and everybody else. So does venture debt compete with venture equity?
Well, first of all, I have to say that Kilok is a mentor of mine, right? So when I first started on the venture equity side, Kilok was a very nice guidance and mentor to me, so I have to thank him for that. And then now I have two very senior bankers. I started my banking career with DBS Bank, and I've had two very senior bankers on the line as well. So I just want to say that venture debt is a very nice mix, and it's a hybrid product of both venture capital and debt, right? So it sits right in the middle there. And picking up on what Tigor says, right, about going after the customer base that nobody wants, right? So venture debt really picks up on the very fast growth companies. But, banks are a little bit very wary of them, right? Because banks want companies that have been around for 20 years, 30 years, have a very good track record. They know the promoters who has been around the scene many times. But when you're dealing with a startup company, right, the founder could be someone who may not even have finished their undergraduate courses, right? But they have launched a business. They're going after a traditional incumbent. They're very fast growth. They're very attractive to investors like Vertex. And at a certain point in time, they become a candidate for debt. Right? And that should be looked upon, and venture debt specifically should be looked upon similar to how growth capital is, right? So when you are looking at a startup company that's growing and they've reached a certain level of traction, then growth capital becomes very important, right? Because growth capital basically addresses the need of operating working capital, right? So like, for example, accounts receivables, right? How do you actually bring in money earlier into the balance sheet so that you can actually recycle the capital to grow the company faster? Secondly, venture debt should also be looked upon like a structured capital, right? So by balancing debt and equity, you can actually reduce the cost of capital that you bring into your company. You reduce the equity dilution as well, and essentially balance up the cost of capital. And that's exactly what the banks do for the corporate customers. So that's in a nutshell what venture debt does.
So it's amazing because, we have an individual here who have actually asked a perfect question that I want to pivot to Jeremy, to Kilok, and to Tigor. He says, we are talking about capital structure here. So maybe the panel, could you share some insights on how does venture debt compares with other forms of capital? I've changed his question slightly because I like Kilok to come in here. Kilok, would you look at venture debt for your portfolio of companies? Would you combine, equity and debt for your portfolio?
Generally, for us, we do encourage our portfolio to access venture debt when they are ready to do it. Typically, like what Jeremy said, venture debt companies are companies which are in the growth stage, and they may not be ready for next round financing. But at the same time, they would like to continue to grow with certain capital to get to that stage. So without the dilution from the equity, that seems to be the ideal situation. You pay a bit of interest, give a bit of warrants, and in return for the continuation of the growth. So generally, we do encourage our entrepreneurs to access that capital when you are ready. However, sometimes, occasionally, we do have a situation whereby entrepreneurs are not really suitable for venture debt. In those cases, we told them not to access venture debt because they are just wrong candidate for venture debt.
Nice. And then I'm going to the traditional bankers, yeah? Ito-san and Tigor. Will either one of your banks then provide venture debt directly to startups? And if you don't, would you partner with partners like, Genesis Ventures?
Yeah, actually, yes. We have already provided venture debt. Until recently in Japan, most financing to startups was coming from governmental financial institutions, while banks were offering loans to late-stage ventures businesses only. So venture debt asset class was still in early beginnings in Japan. And only few market players provide this type of financing. Aozora Bank provides venture debt to startups through our subsidiary, SCI. It's a venture capital, and which launched the first venture debt fund in Japan last year. SCI provided venture debt to Japanese startups with strong growth prospect. Thank you.
What about you, Tigor? Would you work with partners? And how are you?
Well, I think from our side, can you hear me?
Yes, very good.
Okay. I think from our side, we wouldn't do it directly. We wouldn't have the expertise. We wouldn't have the capacity. We just wouldn't have the know-how and experience to do it. And thus, we're partnering with Genesis. And part of the reason that we're partnering with Genesis is obviously, like we all talked about, how some of these entrepreneurs can actually develop their sort of companies and minimize the dilution going forward. But also part of it from our perspective is we want to, as a traditional bank, we can't put our usual lending parameters against it. And that's the venture debt to come in as a, maybe for lack of a better word, a plug, right? So hopefully down the road, let's say 2, 3, 4, 5 years down the road, these guys will be much more established, much bigger base, and a traditional bank can actually expose themselves to these kind of companies.
Very nice. I think today's entrepreneurs and startup founders are very fortunate because the ecosystem is actually helping them to become a growth company. We have one particular question here. I think, Jeremy, you have to take this one. Does venture debt normally have a convertible feature or a straight plain vanilla feature?
So all I can say is go and download the PwC paper because it's all written in there. But just to give you a quick summary, a venture debt is not a convertible loan, right? So there's a common misnomer about venture debt being a convertible debt. A convertible debt, typically, it's a quasi-equity, which means that the investor that provides that so-called convertible loan to the startup company can choose to either leave it as an equity or to leave it as a debt as well. But if you go and download the paper, I think you will definitely get more insights from there.
Very good. All right, Jeremy is telling you, do your homework, all right? Do read that paper because a lot of work went into it. But sorry, Jeremy, I cannot let you get away so easily. So now I'm going to pitch you against the two bankers. Someone here just asked, the cost of debt provided by venture debt is still high compared to the rates provided by banks under the temporary bridging loan and the working capital loan in Singapore. So how do you stack up against those short-term working capital financing?
So I think that, COVID is really an unprecedented situation, right? And, I've come across quite a number of different cycles. And never have I seen the government actually put so much capital to work, right? To not help only traditional corporates and SMEs, but also allow the startup companies to, to be able to profit from that, right? Essentially helping them defray some of the working capital costs by giving them things like TBL, and also, allowing them to defray some of the, for example, employee costs as well, right? Typically, in a situation like a pandemic, which is nothing that we have seen before, the governments typically do not allow startup companies to get into the grants as well, right? So for venture debt, we have to say that actually in a pandemic situation, the risk of the startup companies get even higher, right? The fact that we are holding our interest rate level, it shows the fact that actually we have confidence in the company that we lend to.
Very nice. I'm going to open this question to my whole panel, yeah? How does sustainability plays in investing in a business such as food technology, which has actually a very huge potential in saving millions of dollars? How does that sit with you? Maybe I could start with you first, Kilok. You like food tech companies?
Well, this is a sector that a lot of people are focusing on recently, but to us, this is quite a tough sector. Firstly, it's very broad, and they are starting from early part of the ecosystems to the very much of the technology sector. So it's a very, very broad and wide system. So we do look at it, but we look at it more in terms of where we think is the pain points, where we can solve the pain points, and try to figure out a way to solve it. Less in terms of creating, I guess, CSR, or less in terms of creating sustainability, more in terms of what is the issue that people are trying to solve, and then what people cannot solve efficiently, and then technology maybe can help in that manner. So today we look at that sector, but more in terms of solving of pain points.
Very good answer. All right, answered exactly like what I would expect a veteran venture capitalist to do. But Andrea, is this a big trend? Is this something that you're seeing more and more of our young people being concerned about? Sustainability, and how does that relate to food technology?
No, absolutely. A very, very hot topic at the moment. I think if anyone's doing an investment at the moment, there would be a list of criteria that they probably need to make sure that a lot of the investments meet. I think ESG is still, though, in very, very early days, and people are trying to understand what that means for them as well as their investors. From a food technology perspective, I always find the word technology quite fascinating because, we sort of associate that with innovation and new ideas. But if you look at a Unilever, you look at a Mars, and you look at some of the things that they're doing from an R&D and innovative perspective, they're just as innovative as some of the new and young companies today. So I think you can find, food technology applies very broadly. Obviously, a lot of the smaller and younger companies are a little bit more nimble and exciting to invest in today.
Okay, great. And I'm coming to you, Jeremy. So for, your newly set up funding, congratulations on that new injection of capital.
Thank you.
Are you like technology agnostic, or are you going after certain verticals when it comes to venture debt?
So we're more sector agnostic in a sense that, the venture capital funds are the ones that really drive the innovation in these companies. And when they get to a certain level of traction, right, when they require growth capital, that's where the venture lenders come in, right? Okay. So we don't fund very early stage companies, but the VCs are there, right? So there's a lot of ample capital going around. And when you get to the point where you really feel the pain of operating working capital, right? Like your accounts receivables, come and look for us.
Okay. So, and the accounts receivables can be beyond Southeast Asia? You're looking at global?
So we are a Southeast Asia focused venture debt fund. We fund mostly Southeast Asian technology focused companies. But having said that, we do have a portfolio company that's based in California. They are the market leader for what they do in Europe and the US. But they feel a need to expand their business into Asia Pac, and they have chosen Singapore to be their base. So that gives us a perfect landing opportunity for us to provide venture debt for them. And we funded them last year in the middle of COVID. 12 months later, they are filing for a SPAC, and they're expected to go IPO in the next couple of months. So it's a wonderful delight for us, and we wish them all the success.
Very nice. So with this nicely dovetails to this question from Mark. Are you considering also outside Southeast Asia, say New Zealand or Australia? I'm assuming Mark is from that part of the world. Panel, any interest in New Zealand and Australia to get your support for funding? Kila, you are nodding your head. Over to you.
Well, I guess for us today, for Vertex Global Fund, we only focus on Israel, US, China, Southeast Asia, India. Australia and New Zealand is not a market that we currently focus on. Certainly, there's a lot of innovation there, but there's not enough for us to dedicate a team or funds to focus on that market. So in the short term, next 5 to 7 years, the answer is no. Yeah.
Okay, great. Anybody else want to chip in beyond Southeast Asia?
You can reach out to PwC. We don't do investing ourselves, but we'll put you in touch with our PwC Australia and New Zealand teams who will put you in touch with investors in the region.
Jeremy, I saw you holding the mic.
Yeah, so the way that we operate, right? So Genesis Alternative Ventures, obviously, we are a small fund. Obviously, we are growing our presence, but we believe in working with a network of lenders, right? So in Japan, we have Aozora Bank. They have their own set of venture debt fund as well. We cross-refer deals, right? They can invest in Southeast Asia, and if there's Southeast Asian companies going to Japan, similarly, we can leverage on the network there. Same for Indonesia. So Tigor and his team are helping us to unearth opportunities in Indonesia. And Indonesia is a large opportunity here. There are 6 of the 17 unicorns that are in Southeast Asia are based in Indonesia. So we are delighted to have CIMB Niaga as our partner on the ground there. And beyond that, right, we work with venture lenders in India, venture lenders in Australia as well, and venture lenders in Europe, right? So we can essentially cover the entire world. We may not be able to fund companies there, but we can put you in touch with a venture lender who has specific funding needs in that sector.
Very nice. I wish we could go on forever. I'm watching my clock. It says about 10 minutes, so sorry. The questions are great, but I'm trying to wrap them up. So I'll do a final round and I'll try and incorporate as many of the questions. So let me get back to capital structure. And I think, Kilok, you really need to come in here. Is there a right capital, optimal capital structure? Professors tend to put that up, that there is a right capital debt equity ratio. In your own opinion, all right, how do you think the growth companies' equity to debt capital structure should look like?
I guess for venture capital company, generally, we are not cash flow positive. So the traditional way of looking at debt equities probably doesn't apply. But I would generally say that for startup companies, you should look at it in that manner, what Jeremy sort of touched upon. Essentially, at that point in time when you are trying to grow a company, is it better for you to raise equity, which is could be growth capital, could be early stage fund, or doesn't matter, whatever it is, or is it better for you to raise money from venture debt? So that's something that you should look at it from where you are. And there's no really a right answer or wrong answer in many of these things. It all boils down to how much capital you're trying to raise, where are you in the journey of growth, and the risk reward appetite for the investors. So I think that there's not really a traditional debt equity kind of numbers that you can look at. Yeah.
And for Pak Tigor and for Ito-san, if a startup should go to you in your own domicile market, and they don't have credit record, they don't have collateral, would you immediately send them to see Jeremy? Or do you have like when you say you have a partnership agreement in a way, how do this partnership work out between traditional debt and venture debt?
Yeah, maybe let me take that first. I guess this relates to the question on what kind of capital structure is optimum for a company. As a company starts its venture, obviously loading it up with debt would not be the right thing to do, right? You gotta really put up equity money in there first, right? Whether from seed capital or your own capital or VCs or what have you. But at some point, when the company is actually much more stable and it generates enough cash, then traditional bank, as I mentioned before, would come in because it sees the track record, it sees the cash flow, it sees the repayment capabilities and so forth. But somewhere in between is, that's why I think venture debt would come in to bridge that sort of gap. So when a startup comes to me, I think it depends on where in that evolution that company would be, right? Some, maybe Keelok mentioned that some are ready for a venture debt, some might not be. But it depends on that cycle of their evolution. If they're at the right time for a venture debt, then we would definitely refer them to Jeremy. But even, I'd have to say Jeremy today looks different than when I first met him. He's got a almost full beard on. Almost
the COVID beard. Yeah, that's what happens.
So, yeah.
Very good. And Ito-san, what about you? Because I know for your bank, you're actually one of the earliest who have actually venture debt. So how do you balance between venture debt and traditional debt?
Yes, as I mentioned, in Japan, the venture debt ecosystem is still in early stage. There is no financial product between the equity and the corporate loan. So venture debt is a very important role in Japan. Yeah, we
like
can,
that.
Yes.
That very much, because the growth and the life cycle of a company would go through different phases, and therefore they need as much support from different players within the ecosystem. I'm going to do this last round, and anyone can chip in, because everybody says this is not worth a discussion if you don't put a crystal ball on your panel. So I'm going to start with my live panel here. So put on your crystal ball hat. Equity markets, is it going into a bubble? How long do you think this liquidity would last? Andrea, you have the first word.
I think it's hard. At the moment, if you listen to the central bankers, you're getting very mixed messages, right? I think on the one hand, they realize that their economies and the global economy needs more support. At the same time, they're a little bit concerned about inflation. But every time you hear them talk about inflation, then the markets start to wobble. So I think it's a scenario which we sort of call, the Goldilocks scenario. You don't want it to be too hot. You don't want it to be too cold. You're trying to find something just right.
Okay.
Not easy to do. Not easy
totally.
to do.
All right. Jeremy, you hold first. Keelok, your view. How long is this equity hotness going to last?
Well, if we were to look at the past, traditional in the past, every time we see some country print money, we know the equity market will be hot for 18 months. Other than that, it will go rubbish because, inflation comes in and everything else. I think we are living in a very unusual time today. Every one of them is printing money, not just one country printing money. Everyone is printing money. US printing money, so is China, so is Japan, so is Europe. Everybody's printing money. So there's the amount of capital is a lot more excessive than what we have ever experienced. So this so-called stock market bull run probably will continue for a longer period while because there's just too much money looking for return. But of course, that what it means is eventually the inflation and the down cycle is going to be a lot more worse than what we all have experienced. So I guess the best thing for all of us is while the music is still on, let's try to enjoy it, and hopefully we are not the guy who caught without a chair. So for now, I think it's probably still good. But when it's going to come down, the day after it comes down, I will tell you that. So.
Very good. And I'm not going to ask the same question on Ito-san and, about Tigor, but for the two of you, what are the kinds of companies that interest you tremendously at the moment in Japan and in Indonesia?
Yes. So I don't think I can make an absolute judgment about this bubble question. So the fact is that looking at Japan, certain companies, only 30 companies are attracting money from the market. So it depends which part of the market we are looking at. But the people must see that a significant part of the increase in equity market came from a sector of the new economy, such as technology, the healthcare, etc. The overall economy is changing, and there's a rotation between sectors. I think not all sectors of the equity market will decrease, and those industries which will be the pillars of the new economy will not suffer too much from rising rates. And even within the same industry, some segments have a good prospect, while others will actually experience difficult times, such as in banking sector, online banks as opposed to traditional banks. Thank you.
Thank you very much. New economy, digital, all right, those are the keywords. What about for you, Tigor? What kinds of companies you like?
Yeah, I think, COVID aside, I think once this recovers, and I do believe this will recover, it's just a matter of time, Indonesia will continue its trajectory of growth. And the purchasing power story, the increasing middle class story is still going to be big. It may have taken a pause because of COVID, but I think that story will continue. And anything around that story is things that we do like, whether it's in the logistics around that story, or it's in the healthcare, or FMCG, or education maybe. So there's a lot of actually themes around that purchasing power story that we do like. Now, if you don't mind, just one thing that's interesting about the bubble and the equity markets, which I think Kilok and Ito-san has answered. But what's a little bit interesting this time around, I think, aside from the everyone's printing money and so forth, I just saw a report lately that the cryptocurrency investors in Indonesia now, it's almost the same as the equity investors. So there's about 4 to 5 million equity and capital markets investors over the past, 30, 40 years in Indonesia's capital markets. But just over the past 6-9 months, the same number of investors in crypto. So that's a big question too. When is this bubble gonna burst, if it does?
Very good. And that's why I bring Jeremy last, because Jeremy, you're going to take all those views. And my question for you is, for Genesis Ventures, while the music is still going on, how are you going to be dancing?
Well, that's the reason why we started Genesis Alternative Ventures, right? If you look at the mature markets, where innovation and venture has been around for many decades, the US, Silicon Valley, venture debt plays a very important role in the growth capital needs of startups. And we are not talking about the small, companies. We are talking about the huge, humongous unicorns, right? The Facebooks, the Airbnbs. Airbnb, in fact, raised about $2 billion of debt last year, right? So debt is going to be an important part of Southeast Asia's tech companies. But I think the underlying reason why we launched the report with PwC is that because there's lack of awareness, right? So if we can help more founders and entrepreneurs, right, understand the value of venture debt and not be scared of it, right, but embrace it, I think there's a bright future for it. So there's a lot of money. The money is chasing after yield, And that's why I think, funds like Vertex and Genesis, right? We are attracting the kind of investors to come into us.
Thank you very much, ladies and gentlemen. I think we have a perfect panel one. So a big thank you to my offline and online, all right, panelists and all of you. Thank you.